Hey, welcome to this explainer from the Annuity expert. So, you've worked hard, you've built up some serious wealth, and you're probably thinking, long-term care plan? Nah, I'll just pay for it myself if I need to. Well, today, we're going to dig into why that might not be the best move. Let's get right into it.
This is a big one, right? If you've got over, say, $3 million, do you really need a long-term care plan? It's super common to think you can just self-fund, pay for it as you go. But here's the thing, that's often not the most efficient way to do it. Actually, the more you have to lose, and that means you've got more to protect. Let's break down why.
All right, first things first, let's get real about the actual cost of care. We need a reality check here, because these numbers, they can eat away at even a really big portfolio, and a lot faster than you might imagine.
Okay, just look at this number. We're talking about $14,000 a month. A month. That's for a private room in a nursing home. If you do the math, that's over $160,000 a year. Just gone. Pulled directly from the assets you've built.
And it doesn't stop there. For something like specialized memory care, you could be looking at $9,000 every single month. And the real kicker, that kind of care can go on for 5, 10, even more years. It's that long duration that can be absolutely financially devastating.
So check this out. Here's where it gets really eye-opening. Let's say you have a healthy couple, both in their 70s. If just one of them gets a long-term illness like Alzheimer's, the total cost for their care could easily blow past $1 million. $1 million! Think about what that does to the surviving spouse's lifestyle and what's left for your estate.
Okay, so this gets to the heart of it. The whole idea of just paying for this out of your own pocket, what we call self-funding. It seems simple, but it's got some serious hidden flaws. It's really not just about writing a check every month.
So what is self-funding? Well, it's pretty much what it sounds like. You use your personal savings and investments to pay for care on a dollar-for-dollar basis. And honestly, this is the default plan for a lot of wealthy people. But think about it. You're using your money at a 1-to-1 ratio to fight a completely unpredictable cost. You get no leverage, no tax advantages, and absolutely zero predictability. Not a great formula.
This chart really lays it all out. When you self-fund, every dollar you have pays for, well, $1 of care. Simple as that. But when you use strategic insurance, $1 of premium can buy you $3, $4, maybe even up to $6 of coverage. And the best part? Those benefits usually come to you completely tax-free. Now that is some powerful financial leverage.
And it's not just about the leverage either. There are all these other unseen risks. Self-funding can completely unravel decades of your careful financial planning. Imagine being forced to sell off assets during a market downturn, or getting hit with huge unnecessary tax bills because you had to pull money from an IRA. All of that means less money for your philanthropic goals, and it can seriously put the surviving spouse's lifestyle at risk.
So, if self-funding is so inefficient, what's the smarter way to do this? Let's get into the better ways to plan, because it's all about using leverage to preserve the wealth you've built. We're talking about using financial tools that were designed for this exact problem.
I mean, the whole goal here is to preserve your capital, right? You worked way too hard to build it just to watch it get spent unnecessarily on costs that, frankly, could be covered way more efficiently.
And that's where these smarter, modern options come into play. Look, you've got things like an annuity with a long-term care rider or hybrid life insurance policies. These things are designed to do double duty. If you need care, they can multiply your money to cover the costs. But, and this is the really cool part, if you don't need care, the money isn't just gone. It's not a use it or lose it situation like old school policies. Instead, it passes right on to your heirs as part of your legacy. It's a win-win.
At the end of the day, this is about so much more than just the money. It's not just a spreadsheet calculation. The true goal of planning is about protecting your family's future and, maybe just as important, your own peace of mind.
And really, this quote says it all. Long-term care planning isn't about affording care. That's so true. It's about protecting your spouse and your family. It's about making sure a health crisis doesn't automatically turn into a financial crisis that drains your estate. It's about maintaining control and dignity, so you get to decide where and how you receive care.
So that brings us to the big question, doesn't it? Is your wealth just money sitting there, or is it a tool that you can use to protect your family and secure your legacy? Because a good plan transforms it from a simple safety net into a strategic asset.
So if you're wondering how some of these strategies might fit with your specific situation, we can definitely help. At the Annuity Expert, we can help you compare all the different long-term care products out there and build a plan that's really tax efficient for you. Best of all, our services are always completely free.
Feel free to give us a call for a free consultation. The number is 770-755-1565. Or you can always visit us online at annuityexpertadvice.com. Thanks so much for watching.